How to create ETF investment portfolios. If you stay with me until the end of the video, I will show you portfolio ideas based on your age. To correctly determine what percentage of equities place within portfolios, we must take into consideration two factors: fundamentals, 1. Your risk profile, 2. The time horizon assigned to each investment objective. Let's delve into these two factors. 1. Your risk profile. Your risk profile is determined by three closely related components: risk need, risk capacity, risk tolerance, risk need. Your need for risk identifies how much risk equals how much equity hold you need to take on in order to achieve a given investment. Your need for risk clearly depends on how far you are still distant from reaching the target equity you have assigned to a given goal. The farther you are from the target, in terms of money and time, the more need you have for return to achieve it. In this case, you will have to favor the equity component. Conversely, if you have already allocated a large amount of capital to a goal and you are only close to reaching the amount you set yourself, you need to reduce the equity component in favor of the bond component because you have a high need for return. Risk capacity. It is the ability to financially withstand a loss or a return less favorable than you had budgeted. Risk capacity, in other words, has to do with your soundness, financial strength, and depends on the level of your income, the total value of your assets, and the time horizon of your investment goals. Risk capacity, therefore, aims to answer this question: how much risk can you afford to take on in light of your financial situation? It seems obvious to me that an employee earning €1,500 a month, who has 2 children, and modest financial capital, can take on far less risk than a retired millionaire bachelor. Risk tolerance. It is the psychological predisposition to take risks. Everyone is different in personality, experience, education, and social environment. It is, therefore, quite normal to have different risk tolerances. And it is equally normal for risk tolerance to change with the passage of time. Personal, family, and professional situations change, and with them your risk tolerance will certainly change as well. Identifying your risk tolerance is not easy. We are not talking about objective, measurable financial parameters for which you set a formula and come up with your risk tolerance. It is something you can only understand with practice and can be trained, all the more so if you have understood that in order to achieve a return in the long run, it is desirable and necessary to invest in stocks. A good starting point for determining this is to ask yourself: what is the threshold below which a major stock decline can take away my sleep and make my life worse? -15%? -20%? -30%? -40%? Below is a table that gives you some rough indication of how much stock to hold based on the volatility you think you can bear. Maximum volatility you can handle. Maximum percentage of stock recommended, -5. 20%, -15, 40%, -25, 60%, -35, 80%. The time horizon assigned to the investment objective. The asset allocation must also change as the time you have available to achieve the goal. Why? Because market risk, that's the risk that you can be eliminated by diversification, is reduced to the point of being nullified, at least from a historical and statistical point of view, by the factor of time. The longer and more distant the time horizon, the more you can afford to take a good deal of market risk by investing more in equities. Conversely, if the time horizon is short and close in time, you will have to correspondingly reduce your exposure on the equity asset class, favoring the more defensive component, namely bonds. The money you need 15 years from now for your child to study at a prestigious university must, therefore, necessarily be invested in a riskier way than the money you need in 5 years to start your own company. Again, we give you some broad guidelines on how much equity to hold based on the time you have to reach your investment goal. One last important concept about asset allocation. The difference between the success or failure of your financial plan, and thus the achievement or otherwise of your investment goals, will not be determined by choosing the perfect asset allocation. Unfortunately, the ideal portfolio can only be identified after the fact. We can certainly know what we should have done in the past, but not what will happen in the future. What we can do, however, is 1. Define the percentage of equities based on the time horizon assigned to the target and our risk profile. 2. Reduce risk by watering down the equity whiskey with the bond component. 3. Mixing the asset classes we selected to have the same level of risk in all possible economic seasons. Indeed, while it is true that the most important decision is to decide how much capital to allocate to the equity component, it is equally true that in the portfolios we have included two additional asset classes, gold and commodities, which perform a decorrelation function. So let us look at this second cornerstone principle on which the portfolios are built. Composition of portfolios, asset allocation, the economy, and therefore market risk, goes through various phases that alternate between each other and go to make up the so-called economic cycles. Each economic phase is characterized by a peculiar combination of these four conditions: 1. Inflation, 2. Deflation, 3. Economic growth, 4. Economic slowdown. It follows that there are basically four economic seasons that alternate cyclically. 1. Growth phase, given by the combination of economic growth and deflation. 2. Expansion phase, given by economic growth and inflation. 3. Recession phase, given by economic slowdown and deflation. 4. Depression phase, given by economic slowdown and inflation. During each economic season, there are asset classes that perform well and asset classes that perform worse. Some perform well during the growth phase, and poorly during the recession, others that perform well during the depression phase, and poorly during the expansion. Growth, stocks, commodities. Expansion and inflation, stocks, gold, inflation-linked bonds. Recession, gold, safe haven currencies, short-term bonds. Depression, liquidity, short-term bond. This is because, as economic seasons change, money is not burned, but will simply flow from one asset class to another. The problem is that, unlike the stable cycle of seasons in nature, the seasons economy do not follow one another in a set order. We cannot know what the next economic season will be. Exactly the same way we cannot know which asset will do better in the future. If I knew, I would put all or most of my eggs in that basket. But it doesn't work that way. So the goal must be to build robust portfolios that perform well in any economic scenario and that keeps the amount of risk in all possible economic, expansion, contraction, and monetary, inflation, deflation. Portfolios that can hold their own when stock markets are plunging and ensure profits when markets are rising. All-season or evergreen investment portfolios that contain within them all the major asset classes, balanced in the right proportions. You have to build a strategic asset allocation on the assumption that you don't know what the future holds. Cit Ray Dalio, and this is only possible by including within portfolios asset classes that are decorrelated to each other, such as precisely stocks, bonds, gold and commodities. Commodities. Warning: building portfolios that perform well under any scenario. Economic scenario does not mean that you will not experience downturns during your career as an investor. But it does mean averting the risk faced by all investors who invest thinking they can get in and out by anticipating markets, namely the ruin risk. It will also be the right portfolios that will enable you to achieve your investment goals and avoid going astray when the financial markets will be stormy. The Strategic Asset Allocation of Portfolios 2022-23. Portfolios, Asset Allocation, 20 by 80, 40 by 60, 60 by 40, 80 by 20. Stocks, 20, 40, 60, 80. Bonds, 70, 50, 30, 10. Alternatives, 10, 10, 10, 10. Recommended time horizon, 3 to 5 anni, 6 to 7 anni, 8 to 9 anni, 10 anni plus. What is the optimal allocation between stocks and bonds in a portfolio? There can be no single answer, but perhaps there is a simple and practical rule to follow. Jack Bogle, one of the best investors of all time, suggests that the fraction of stocks should be reduced as the age of the saver increases. In fact, at 20, the investment strategy should be very different from what one assumes at 60. So if I were 40 I would do this portfolio asset allocation. Portfolio 60/40. Stocks, World Stock, 30%. Stocks, Europe Stock, 15%. Stocks, Emerging Stock, 15%. Bonds, U.S. Government Obligation Short Term, 10%. Bonds, Obligation Government Europe Short Term, 10%. Bonds, Obligation Government Europe Inflation, 10%. Alternatives, Commodities, 5%. Alternatives, ORO, 5%. I hope you liked the video. In that case I invite you to subscribe and put a like to support the channel. Thanks.